Hello everyone. We're going to take a look at how you can profit from market volatility and market crashes. And as promised in yesterday's video, we're going to take a look at what the results of the live signals on our Fast 50 US equities pairs pair trading signals were during the last 6 months in a couple of different periods of the market crash. So let's take a look at where we are today. Here's a graph from Yahoo Finance, and what we're looking at here are the three major U.S. indices, the S&P 500, Dow Jones Industrials, and the NASDAQ over the last 5 years. And this is their daily return profile. What we can see is we had a big crash here in March 2020, which quickly rebounded. And despite that crash, since that point, it's basically been a long-only investor's dream market, especially for the NASDAQ. As you can see, a very steady and rapid rise over more than a year and a half. So that's been creating a bit of complacency for a lot of stock market investors. It's very nice to see your account going up 15-20% a year while you do nothing long only. However, the situation changed at the beginning of this year when the Federal Reserve and other central banks began an interest rate cycle, tightening cycle. And what we can see is that there's been a significant deterioration in all three averages into bear market territory from the beginning of the year until about middle of June. The averages then rebounded and have since begun to retrace once again since Jackson Hole and Powell's comments about continuing the rapid rise of interest rates. But what we're going to do in this video is take a look at this period here of the market crash and see how our top 30 and Fast 50 US equities pairs have performed in those types of markets. Before we jump into that, let's just take a look at the long only case. So here's an indicator that we like to keep an eye on, and this comes from Guru Focus, which is a great site. If you ever get a chance, check them out. This is the Buffett indicator, and Buffett likes to use a very simple indicator to determine whether or not U.S. stocks are at a good moment in their valuation to commit new capital to. And his traditional indicator is the total market capitalization using the Wilshire 1000, and that's over gross domestic product of the United States, total GDP. And here's the chart you can see. Let me just get a pointer going. You can see the chart here. We had the major market crash in 2008, and it took it down from 100% total market cap to GDP down to about 50. Then we've been climbing ever since. There was that 2020 drawdown I mentioned on the last slide, and then just a massive, massive revaluation taking us up to nosebleed levels, which I mentioned back in February. So 200% total market cap to GDP. So this bear market that's been entered into, or this drawdown that we've had until mid-June, taking us only down to about 150%. Now, even if we add in all the assets of the Federal Reserve that they have sitting on their balance sheet through their QE programs, and add that into the GDP, we're still looking at about 119.5%. So if you're going to commit capital to the markets right now, do you want to go long only? Well, on the basis of the traditional indicator, Buffett would say no way. It's at 162%. The likely return is only 0.7% a year from this level of valuation, including dividends. And even if you add in all the QE assets that are slowly being run off now with quantitative tightening, you're still looking at a modestly overvalued market with a likely return of 2.3% a year from this level of valuation, including dividends. So right now, the long-only case, despite this massive retreat in stock prices over the last 4 or 5 months, is still not very compelling. So let's take this back to pair trading and the topic of market crashes, or these drawdowns, or these periods where we know that the long only case is not looking very good for the foreseeable future. This is a research report produced by Deutsche Bank back in 16 February 2016, and the title of the report was Mean Reversion 2 Pairs Trading Strategies. I'm going to summarize the essence of what we're trying to say here with respect to volatility and pair trading returns. And to quickly summarize what they've done, they've looked at the returns from a final pairs strategy, they call it here, where they've designed, it's a European pair strategy. It's trading the top 500 shares in Europe. It's looking for correlated shares. It's doing a 2.0 entry stretch, a 0.0 exit stretch. They overlay a fundamental correlation filter like we do at PairTrade Finder to make sure that these companies, when they're paired, have the same fundamental characteristics or factors driving their business. And they've overlaid a new sentiment indicator, which is like screening for corporate action news events like we do at PairTrade Finder. So basically, this is a European pairs trading strategy with those two filters that we use, but using a 2.0 entry stretch and a 0.0 exit stretch. So and then they've laid that in this chart here. They've laid the average monthly returns, okay, average pairs monthly returns from this strategy against the VIX over the same period. And where we circled here, these red ovals, okay, what we want to show is that every time the VIX spikes, you get a spike in pair trading profitability. And let's be clear, this is a self-financing portfolio, so there's been no leverage applied here. We would, as retail or personal traders, individuals, we could realistically and conservatively support double the leverage of what's being done here. So we could also anticipate somewhere near double the returns. But what you can see is that the average return seems to be about 0.8% over this period. And we're looking at 2002 all the way till 2015, so about 13 years. But the point I'm driving at is when VIX spikes, when the markets crash, when there's trouble in the markets, when markets are undecided, volatility is high, pair trading returns rise. And here's the 2008 crash, massive spike in VIX, massive spike in profitability of pairs returns. And again, a spike here, another spike in profitability, and another spike here in VIX, and another big spike in profitability here, up to almost 2% per month. So key takeaways, it's clear from the graph that there's a positive relationship between pairs trading profitability and market volatility. In line with the properties of mean reversion strategies, pair trading tend to work better in periods of high volatility. So, okay, the long-only equity case is not great right now, but the case for pair trading has never been better. Let's move on to another study. This one was done at the University of Amsterdam, performance of pairs trading during a financial crisis. And what this student has done in her work is to compare the returns on pairs from the S&P 100. And important to note here, she's using a very somewhat unorthodox strategy for trading these pairs, I guess because they're pretty stable, being S&P 100. She has an entry stretch of 1 standard deviation and an exit stretch of 0.5 standard deviation. Interesting strategy. Check it out sometime. You could use PairTrade Finder Pro, for example, to backtest that and look at it and see whether you can make money with it. But getting back to this, she's done this over 2 periods, 2003 to 2005, and then 2007 to 2009, which includes the big market crash we talked about at the beginning of this presentation. And so what you can see here, this is the weekly volatility of the S&P price index, and the purple line is 2003 to 2005, so anywhere between about 0 and 1%, and then the green line is 2007 to 2009. Couple of big spikes here, much more volatile period, but then the big market crash, huge spikes in volatility here. So she's looking at 105 trades from each of these periods and saying what was given this much increased volatility in the S&P 100 versus in the 2007 to 2009 period versus 3 to 5, what was the difference in average weekly returns? And she found that in the quieter periods, the average weekly return was about 0.15%, and in the highly volatile period, it was 0.5%, with a double the Sharpe ratio of what it was in the quieter period. So very interesting. Interestingly, here again, this is unlevered, self-financing basis. We would, as individual traders, be comfortable with probably double the leverage here. We could expect potentially double the return. if we were trading this strategy with double the leverage. Over that 2-year period, the pair trading strategy did 15%. I think the market didn't do much. And in the volatile period, the pair trading strategy did 54%. Quite interesting. So you've seen some interesting research that shows that profitability is good during market crashes for pair trading strategies. So how about we look at some of the live signals that we produce from our Fast 50 and Top 30 pairs and see how they did in those periods. How do those results compare? We've got 2 sets here that we've done this year. The first was the February 2022 vintage, and we've tracked those results from basically February 1st until the end of March, so 2 months. And then the second set is the May 2022 vintage. We tracked those results from the beginning of May, 2nd of May, until the end of the 3rd week of June, and about 7 weeks. And let me highlight that in both these cases, we're talking about unfiltered live signals. We have not applied any filters for corporate actions, for earnings releases, for anything that might fundamentally impact the value of one of the symbols in the pair. And that's something we would do in our normal trading, but we haven't done that here. These are just unfiltered raw signals. We also haven't applied any trade management techniques, trailing stops, trading to target, and the like. So again, raw signals. Feb 2022 vintage, 24 closed trades in those 2 months, 19 winners, 79% win rate, 0.8 average reward to risk, giving an 11.1% net return, and that's using 4-to-1 leverage, and that's net of all commission slippage and margin costs. S&P 500 total return in the same period was 2.5%. So our excess return of our trading signals over the period was 8.6%. These were delivering 5.4% approximately per month. That's an interesting number. We're going to see it at the end. The May 2022 results were on an absolute basis not as attractive, but still very respectable. But on a relative basis, were quite illustrative of the power of pair trading and its non-correlation to the equity averages. So there were 17 closed trade, 14 winners, 82% win rate, 0.5 times average reward to risk, and a 6.1% net return over the 7-week period. It's about 3.5% per month. Interestingly, though, the S&P 500 in the same period tanked almost 11%, and the excess return of our trading signals over the period was almost 17%. So again, that's very important. If you have $100,000 in your trading account on 1st of May, if you just left it in the SPY ETF by the end of June or June 17th, your trading account balance was about $89,000. Had you been trading these signals on a position size basis as we do with that 100,000, your trading account balance would have been theoretically and hypothetically 106,000. So that's a very big delta, 17% delta in 7 weeks. And that shows you the power of using an uncorrelated and consistently profitable trading strategy versus a long-only strategy. What about other Fast 50, Top 30 sets? How have they done? Doesn't always have to be in periods of market stress. How have they done in normal trading environments? Or gentle bull markets like we've seen, or raging bull markets like we've seen? Well, here are 3 sets. Here are some blog posts where you can go. If you type in these URLs, you can get the details, including all of the trades, open book, everything you can audit. So one set, 17.3% in the first 8 weeks, another 9.3% in 5 weeks, and another one, some amazing results, 11.6% in 3 weeks. It's important to know that, in-sample backtests are great, and the stuff we put out with Fast 50, Slow 60, Top 30, the backtests always look amazing. Otherwise, we wouldn't have chosen those pairs. However, out-of-sample live signals in most quantitative trading systems generally deliver about only 50% of backtested results. So keep that in mind. We trade these pairs ourselves, but when we do, we filter the raw signals, and we avoid taking trades where there's divergence is due to fundamental value shifting events, mergers and acquisitions, divestitures, spin-offs, scandals, major litigation, company management guiding significantly lower or higher for a sustained period. And we show you how to do that quickly and easily. Nevertheless, if you just take these raw signals, this is the type of performance that they've been able to deliver on a out of sample basis, live signals that you could have reviewed and traded. So with that kind of result, you would think that people would be pretty happy with our service. Well, we're just going to highlight here. So what do our customers say about PTF Pro and our Fast 50 curated stock pairs? These are all unsolicited, and we get some great emails, and we're very happy to receive this feedback. So if you have any, good or bad, please always send it to us. We use it to try and improve our service and our techniques. We're open to any suggestions, and we take constructive criticism very positively. So here's Mitchell Weiss. I used to manage a prop firm in the 80s. We had over 1,000 traders. We did a lot of pair work back then. You have an excellent program. I've been testing your top 50 pairs for about a month or so, and it is doing quite well. Another one from Chris Stone. I'm amazed that more people are not using your software. I've managed to make 8,000 in the last 3 weeks. I credit that to you, your staff, the great videos, and the excellent software. Let me say that I love your product, and I intend on being a lifelong user. I'm truly grateful. Awesome to hear that kind of stuff. Let's close the old just to say how delighted I am with your product. For the first time in 10 years, I'm consistently profitable. Wow. That's stuff that makes us really happy. For somebody to have been trading for 10 years and not have consistent profitability is frustrating, to say the least. I'll let you guys and gals read through this as you like. There's a few more here. There's also about 30 or 40 more on our website. So, feel free to go to www.PairTradeFinder.com and check those out. I'll just leave you with the last slide, and this may be a bit disingenuous, so please forgive me. But there is a rule in the universe called compound interest, which is one of the most powerful laws in the universe. And here we want to just do a quick little illustration. This isn't suggesting that this could be done or that this is a realistic view of how you might trade pairs. However, it is a mathematical extrapolation. So let's say you had a $30,000 trading account and you were able to achieve that 5.4% monthly return that we showed you from the February 2022 vintage of the Fast 50 pairs. So you start the year one, with 30,000, and you're trading away, and then by December you're up to 56,000. And you don't take money out of your trading account, and you just keep doing this. And if you're magically able to deliver this type of return on a consistent basis, now it never will be. There are ups and downs and ups and downs. But this is what would happen with this compounding. The next year you'd end the year at 106. The next year 200,000. You're almost doubling every year. And at the end of year 10, the balance would be up to 16.7 million. So those are the kind of the crazy growth that we saw when we were looking in the last video at Renaissance Capital, how they turned $1 into 4 million over the course of 30 years. That's what it's all about. That's why people trade their own capital. It's to try and build a system which can consistently deliver monthly returns that can compound. And we would just reiterate once again that PairTrade Finder Pro can be managed in as little as 1 hour per day, and often much less once you've learned your craft. So that's food for thought. And stay tuned for the next video. It'll be coming out tomorrow. Hi everyone. So for those of you who've made it past the main presentation, we're just including here an appendix, further details on the return calculations. If you're interested in seeing those, how we go about getting our imputed equity, how much money we would need to hold in order to trade this portfolio of Fast 50 or top 30 pairs, you can follow on in the next 2 slides. Happy trading. These next couple of slides are just going to drill in detail into those performance stats we just showed you. We think it's important that you see that we do things in a proper way and with a lot of granularity. Here are the backtest results of those February 2022 vintage before we launched them. They were backtesting at about 6.6% per month over the last year with a 97% win rate and 3.7x reward risk. The actual trading came in at 5.4% per month with a 79% win rate and a 0.8 times reward risk. You can see the performance of the S&P 500 SPY ETF total return over that period, about 1.2% a month, and we were doing 5.4. So important number. Think about that, 5.4% a month. We're going to talk about that later. Here are the a more detailed analysis of the May stats that we gave you. Again, we repeat the stats here, but this is just showing you the number of closed trades, total net profit, average net profit, the win rate, average days in trade, average reward risk. Again, this is the one that had this big loss, which could have been mitigated through trade management, but as we're just doing raw filters, raw signals, no filtering and no trade management, this is what that would have played out at. And again, it came in at about 3.5% a month, but importantly, at a time when the S&P 500 was down over 10% in those 7 weeks, so about negative 5% a month. So this was doing almost 8% a month of alpha.